I am very happy to welcome back one of the OGs, the original gangsters, Matthew Timpane from Schaeffer's. Matthew, how's it going, man?
Not too bad. How about yourself, Neil?
Wonderful. There is nothing on a global or local scale that could possibly keep me down on a beautiful day like this. So I'm very, very happy to have you here. Would you mind giving folks a brief introduction to yourself and what you're about to teach them?
Yeah, so my name is Matthew Timpane. I'm a CMT and a senior market strategist over at Schaeffer's Investment Research. We're located in Cincinnati, Ohio. We're actually going on our 40th year anniversary this year. So while many
Congratulations.
yeah, thank you. Well, while many have come and many have gone, we're still here, thriving in the options market industry. And we want to kind of go over some common option trading mistakes. We figured it's a good way to kind of start the year here, just to remind people, not to make these mistakes when they're trading options. And it's a nice reminder and a little bit of a change up from my usual chart storm that we kind of do. So I think it'll be interesting for everyone.
Hey, I'm glad to see a variation on a theme. I'm really excited to see what you have for us. So, with that said, I'm going to get out of your way and let you go.
All right, wonderful. All right. All right, everyone should see screen 2. All right, perfect. All right, as I said, I'm Matthew Timpane over at Schaeffer's Investment Research. We're going to cover some common option trading mistakes.
Hold on, Matt. I don't think it's up yet.
Oh.
I think you might want to try again.
Share screen. All right.
There it is.
Perfect. Now we're up and running. All right. So as we go on to the first slide here, one of the first mistakes that we want to kind of just cover is front running your drivers. Many traders are typically impatient and yearn for action. This is natural. Obviously, when you're on a winning streak, your endorphins start running. So you can end up being a little bit impatient, which can lead to front running these drivers that you have when you're looking at entering a trade. For example, say you're waiting for a pullback to support at 40 on a stock, but you see the stock you like at 41.5 and buy ahead of that support that you may have identified correctly, but now you're going to only hurt yourself by creating a sloppy entry. For one, now you're going to be battling time decay as it tests support, and now your option could be worthless if you're doing an extremely short dated expiration, or at the very least, it's going to be 10, 20% lower, even if you returns to 41.50, unless implied volatility is expanded. 2, you're also battling time in itself because, as we kind of just already alluded to, you have an expiration date. So you're buying an option, you have a set period of time to be right. So these factors can actually cause you to get whipsawed a lot. And because of this, if you're managing your risk properly, a small move, obviously, in the underlying can be a big move in the option, causing you to have premature exits and limiting losses for proper risk management. And this will cause lower win rates and lower average wins. So when you think about it, if you just waited instead of being impatient, the option you purchased would cost less and your leverage ratio potential would be greater. People often make this mistake, and it's something we just kind of want to make sure that people don't do this, because there's always another trade out there, and just being patient is the best way to go, because what it does is it just leads to these sloppy entries, causes these lower win rates, buy premature exits that could have been profitable trades, and have lower average wins, because the gains are going to be less when you actually do hit your profit targets that you identified at the outset. Kind of on to a theme I know our last presenter kind of talked about: let your profits run, cut your losses. All too often we forget how important this aspect is of risk management, being a successful trader. So it's always a healthy reminder that we need to do this, especially when trading options. This takes advantage, though, also of the power of convexity when you're trading options. So you can see here, it's a simple formula. Anybody can use it. You use your win rate times your average win minus your loss rate times your average loss equals your expected return on your dollars. So if you look, you'll see that if you have a 40% win rate with an average of an 80% win, with a 60% loss rate minus that, at a 35% average loss, you're still profitable P&L at 11%. That's much better than having a 60% win rate, but you're taking profits early because you're kind of getting scared and you want to get those profits. When you're looking at a 30% average win, and then you're taking larger losses on a 40% loss rate at 60%. That's just a losing strategy. So you don't have to have a huge win-loss percentage, and that's kind of going to be a theme a little bit over some of this. The next kind of thing is overcome greed. So when you have hit your profit targets, and we typically aim kind of for 100 to 200%, depending on the risk parameters of the trade and the length of the trade, take half off, de-risk your trade. Let the rest work for you. Let that power of convexity keep going. Maybe place a stop loss at break even on the remaining contracts that you do have out there, though. That way you can ensure that you still have a nice profitable trade, even if things go greatly against a trade that was working in your favor. Always use price stops. My kind of motto that I say all the time, always honor your stops. And a good rule of thumb is to never really let your losses exceed 50% when you're options trading. I typically target somewhere between 30 and 50% depending on the risk of the option and my upside targets. Also, have a time stop. This is typically extremely important really when trading shorter term dated options, especially. You want to typically kind of look at the half-life from the date that you purchased the option to its expiration date. If the stock is just not doing what you expected at the half-life, get out. If you think that maybe it just needs more time, roll it instead of staying in it, so you're not battling time decay. Another mistake is allocating too much capital to a position. So we have this chart here at Schaeffer's that shows the probability of statistics of seeing X number of consecutive losing trades in a row. So, but first kind of let's get to know why this is important to know as an option buyer. As you can maybe allude to, I showed you, you only have to be right 40% of the time to be a profitable trader, and options traders typically are only right 35 to 45% of the time, as I showed in that previous slide, the 40% win rate. So let me kind of explain that a little bit further. The best traders really in the world only have about an average win rate of 50%, maybe 60% at best. I'm not talking really about investors that hold positions multiple years here. We're talking traders who hold positions for a few months to a year or so. What makes these stock traders so good, though, is, as I said before, they cut their losses fairly quickly and they let those winners run. So stock buyers do have also a couple advantages over option buyers. They can hold the stock as long as they want to have that winner. They might have an opportunity cost, but unlike an option buyer, they theoretically have an unlimited amount of time, whereas the option buyer has a defined window of time to be correct due to the expiration date. The option buyer also has to pay a time premium. So the more time they buy to be correct, the more time that time premium is embedded into the option price. And time premium decays in a non-linear fashion as the option approaches expiration, which I'll show you on a slide quickly next. So those are a couple headwinds that option buyers face, which causes the lower win rate than stock traders. So knowing this, you could look at the probabilities to figure out what your chances are of being wrong X amount of time. Say your win rate is 40% over time. If you look at the probability chart, you can see that you have a 63% chance of being right, or of being wrong, of having six consecutive losing trades here. So having this mentality of this next trade has to be profitable, I'm going to double up or triple up, can be absolutely disastrous to your P&L. Even if you pay for a service like ours or somebody else's, or if you're following experts online that have years of experience and are excellent at buying options and trading, having that mentality That next trade has to be right is just a real quick way to lose money. And when you look at it on that seventh trade, they could still be wrong 42% of the time. So quickly, as I alluded to, I just wanted to kind of show here the time decay of an at-the-money option. So as you approach expiration, this is in a nonlinear fashion degrades. So this is why we talk about rolling that option if it's not working, or just getting out, because oftentimes, it may be going right in your direction, but it's not hitting your profit targets. The closer you get to expiration, the bigger loss you're going to have. This is how you end up having 75% or even total losses of 100%. Another mistake that we see on allocation factors is that options traders allocating the same amount of money or percentage of their portfolio to options that have different risk reward characteristics. So let's get a little bit more into detail about what I mean here. A lot of option buyers, and especially new options traders, will buy the cheapest options, buying 50-cent options versus the $5 option. One of the things I believe that doesn't help is, a lot of the new mobile apps, they kind of bring you straight to those out of the money options instead of like the old montages kind of bring you straight to at the money options, so you can kind of see out the money and in the money options as well. Also, people are just naturally programmed to buy cheap and try to sell high. We've all been told that since we were little kids, even about the stock market. That's what you kind of do. But these options are out of the money. So, those options likely have anywhere from 90 to 99% of a chance of expiring worthless. And with these options, you can be right in the direction. But as I've said before, if you don't hit your price target goal, you still can expire worthless and have 100% loss. So you need to have this understanding of out of the money versus in the money. And out of the money gives you a higher profit potential, obviously, but also you have a lot higher risk. So you need to allocate appropriately and less to out of the money and more to in the money options. Also, you want to allocate less money to shorter term expirations versus longer term expirations, because that time decay isn't working against you as quickly as they are and shorter dated options. So quick example here, we can kind of just go over. You'll see that buying stock, 100 shares of $107 stock, if it goes unchanged, you'll be at break even at expiration. You'd be profitable if it goes to 120 by 12%, $1,300% or $1,300 profit. And then if it goes down, to 105, you're only down 2% or $200. But you are putting $10,700 of buying power at risk. Whereas if you're looking at an in the money option at $9 for the contract, you're only putting up $900. So if it's unchanged, you are down $200, but that's not significant compared to what dollars you're putting at work. And then obviously you have a profit of 122% if it goes up to like 120, and then you would have a 44% loss if it goes down to 105. But you'll really see the difference buying at the money options versus in the money options here, because when you buy, say, two at the money 107 strikes for 550, even if it goes unchanged, it's 100% loss at expiration. This is where you unlock the profit potential, though, of greater gains. So you just need to have a good understanding of out of the money versus in the money and what type of trades you're getting into and why. Another thing that we like to do and mistakes that we want to avoid traders to make is, like any good stock portfolio, an options portfolio should be diversified too. A major advantage of trading options is truncated risk, whereby your loss is limited to your initial investment, yet your profit is theoretically unlimited. So diversification will allow you to use truncated risk to its maximum advantage. We believe in using a two-dimensional kind of diversification system. You can see the key to really kind of achieving profits in options trading when you've been in it a while is to maximize your chances of having very large percentage gains. This kind of requires financial and emotional staying power provided by a couple of trading rules that help ensure that you will be around to achieve those huge profits. It's kind of like that old saying, the 80-20 rule. 20% of your portfolio is going to provide 80% of your gains. So this really kind of involves reducing risk and profit maximizing techniques in diversification. First, you should always kind of try to carry several different option positions to maximize your chances and achieve one or more huge, large winners and minimize those chances of incurring those large losses that in these option positions. And they should be established in unrelated industries. As we know, trends can change quite quickly, and this will help eliminate any unforeseen risk that might occur to a certain industry or sector. Second, you need to invest in puts and calls as well. This will put you in a position to profit regardless of the overall market conditions, so that if you guess wrong on the overall market direction, you're not severely depleting your trading capital. I get, that it's extremely hard to do that, especially in a rip-roaring bull market like we're in today. However, your ratio of calls and puts should vary according to your overall market view to reflect that, which will make that easier. These steps will help you stay the course by reducing fear and hopefully eliminate any kind of panic selling that traders often do, exiting as soon as the position moves against them, and lets you stay in those trades a little bit longer so that you can reach either your defined stop loss or your profit targets. Another mistake that we kind of do see here is poor option selection, or really kind of mismatching drivers with their option expiration date. We see this kind of all the time. Traders will be targeting drivers that are more short-term, but then buying longer-term options, or vice versa. So just for example, when you're looking at something like short interest covering, or maybe an analyst upgrading or downgrading, these drivers can take time to play out. Shorts don't typically run to the exit overnight. They typically kind of, if you ever look at short interest data on a chart, it flows much like price action. You'll see, anywhere from maybe 10% to 20% covering in a 2-week period. You're not going to see usually 50%, 60% type covering. And as well with analysts, they don't always necessarily upgrade immediately. A lot of times they have to update their models. They're thinking about the future, how are earnings going to be in the future. So to get those upgrades, it may take some time. Likewise, option traders sometimes use, short-term indicators that are really good for short-term trading and buy longer-term options. So we like to use the buy to open 10-day put call ratios, as we've discussed in the past, or our proprietary volatility scorecard that's really based on like a 21-day cycle. But you want to use those types of trading indicators and those edges in short-term options, because that's what they're meant for. You're really reducing your leverage power and not maximizing your gain potential when you're using a longer-term driver or a shorter-term driver on a longer-term option. And then finally, we have some other things here that we just kind of want to touch on as we wrap up. Focusing kind of only on one time frame, you want to really review your charts from intraday to monthly. I know as we trade options, we typically always look at shorter term charts. We're fixated on daily charts, hourly charts, all the way down to even 5-minute charts. But it's extremely important to zoom out to weekly and even monthly charts to make sure that you're not going to run into resistance on a larger time frame level that you may not have seen, because you're only seeing a year's worth of data. This could be from 5 years ago. This happens all the time. It will stall a stock and you didn't even see it coming. Or maybe you're looking to buy a put on a stock because it's bear flagging on the daily and about to break down, but you didn't realize directly underneath is a 10-year support level going back, and that's just going to stall the stock, and it's really going to fake people out, and it really hurts your P&L when you're trading like that. You don't want to also react to the noise. First, you're not really faster than the machines or the algorithms. You're never going to be. Secondly, it's a great way to get whipsawed. Oftentimes you have a volume surge on news. If you're not in the stock already, my suggestion is to kind of just wait it out. If you think that news is worthy of a position, give it some time, be patient, and it will most likely pull back so that you can get a better buying opportunity. If it doesn't, again, you just have other option trades, and other trades will come up. Sometimes you just got to let them go. And then finally, trading illiquid options. This doesn't matter as much when you're trading a few contracts, but as you increase size, it will matter a lot. So entering into a position with no open interest or stock that generally just has little open interest will stick out like a sore thumb to market makers. We kind of call these roach motels at our firm. They're going to let you in. So it's like kind of like the Hotel California. They're going to let you in, but when you try to get out to manage risk or even take profit, they're going to widen these bid-ask prices on you, and so much that your exits are going to be extremely inefficient and sloppy. Often, this will cause you to have much larger losses than you really should, or even reduce some of your profit that you should have had in a trade. As always, thank you for your time. We'd love to chat with you about your, options trading over at schaefersresearch.com. We have tons of online educational content for all of you. We do offer services as well so that you can trade right alongside of us. And if you have any questions, feel free to ask.
Wow, record time, Matt. Thank you so much for going over that. Super interesting. Chad had a few questions on some basic, what I think is pretty basic option stuff. Do you have time? I know you probably got to take off. I'm just wondering if you have time for a couple questions.
Yeah, I got plenty of time.
Okay, cool. So one is you mentioned like selling half off, right? Am I right in that?
Yeah,
could you explain
correct.
that again?
Yep, correct. So when you typically hit your profit target that you're looking for, like I said, we typically target 100% or 200% profit targets depending on the risk. So if we're looking at like maybe a longer term dated option, it's going to be about 100%. But if it's like a 30-day or maybe even 45-day type of shorter term dated trade, we're going to be looking for those 200% winners, especially if we're playing like at the money options. But we think that once you hit that profit target, take half off, de-risk, and then let the rest of that just work for you into expiration as long as you continue to have a positive price trend. There's multiple ways you can look at it. Like I mentioned, you can cut it off at break even if you wanted. That way you're still going to have a profitable trade. If it's at 200%, you put those remaining contracts at break even, you're still going to have a 100% winner there. Or maybe, use a moving average. Maybe if it breaks down below the 10-day moving average, just cut your losses then as well.
So my follow-up question to that is that, and this came up, this is like a sort of a technicality. If you're selling half to get your profits, you must have purchased more than one option.
That's correct.
Right.
That's correct. A lot of the times, I know a lot of the people that trade with us, they're purchasing, anywhere from 2 contracts to 20 contracts or 40 contracts. So, they're going to be able to do that. Yes, if you're trading just one contract, that's kind of tough. So my suggestion at that point would be to kind of just try to keep building your portfolio as best you can so that you have that ability to do that in the future.
Got it. And then a question came up, and guys, that was a great question. I know that might seem obvious to some of you, but options, options you can almost always continue learning about. There's so much that can be done with them. So no silly questions there. And guys, if you have more questions, feel free to drop them in while we still have Matthew here. Now, how do margin requirements come into this when you're talking about their brokerage, when you're talking about your brokerage settings?
Yeah, so for margin requirements, that's more for obviously when you're selling options and credit spreads. So those will come into play. So when we're looking at credit spreads or selling puts maybe, and we don't do a ton of that, but we do provide that service. And it is kind of a more conservative factor that we use. We're always looking for, on like a credit spread, say you have a credit spread, you're always looking at a minimum of a 10% gain. That's what you want on your margin. A minimum 10%, maybe 20%. And then when you're kind of looking at cutting losses on those, one of the big things is, a lot of people will say, well, I'll just sell them, and then if they go to zero, I'm just out that difference between the credit I've taken in and then the dollar. I think that's the wrong way to kind of do it. I think you should really kind of target maybe a 50% loss on that. You are going to have a much higher win rate when you're selling options. That's how you're targeting it. That's why you're using it. It's a much more conservative approach, but it can get you into trouble, obviously, especially if you're outright selling puts. So when you're outright selling puts, you're going to have to take ownership of those shares if it goes in the money. If it's close, we would say take ownership of the shares as long as you can afford that. If you can't afford taking ownership of the shares, you probably shouldn't be selling outright puts. Look towards credit spreads instead. But when selling outright puts, again, we're looking anywhere from 10 to 20% gains really on those, just like our credit spreads. And then hopefully you can cut your losses a little bit earlier on the credit spreads, like I said, about 50%, because you are going to be right 80 to even 90% of the time when you're selling credit spreads, because you're selling those out of the money. You just have the probabilities in your favor at that point.
Mm-hmm. And the last one, a very basic one. Could you explain what it means and perhaps how it's done on most brokerages, rolling over a position?
Yeah, so rolling a contract, places like TD or Tastyworks, or a lot of them have great features where you can roll a contract. So what it is say you have at the money February contract, and we're standard February, which I believe expires on the 19th of next month, and say you're at your half-life, so the beginning of February, and your at the money option is at break even, and you're still kind of strong on this contract. What you'll do is you'll simultaneously sell that contract that you have and then buy the contract in maybe the front month or the front 2 months. So that way you're kind of keeping your exposure. So you're selling and buying at the same time to keep that same exposure. So it's called a roll. Tastyworks does a really great job about that. I know you can literally put up a roll and they'll put the front month up there for you. I think TD kind of has some parameters in that as well. I don't use it inside of Thinkorswim. I'll maybe build out a custom way to do it, but those are great places to look at, and it's a great way to do that if you're still bullish on the stock and maybe it just hasn't worked for you yet.
Wonderfully said. Thank you so much for your time, Matthew Timpane. Just one thing I want to end on is for folks going over to schaeffersresearch.com. What is the number one thing? If you could just give us very clearly in an elevator pitch, what's the one thing that they can expect to get from you guys?
They're going to get up-to-date option news that's unique, different than anywhere else. We do all kinds of kind of like internal things in databases with our put calls. We look at buy to open data versus the data as a whole. Now, this is telling you exactly where retail's buying and selling. We think this is a huge advantage. We also actually list our volatility scorecard on our website. And this is a proprietary indicator that we use that tells you how volatile the stock has been. So we're using kind of like a straddle type strategy around this, and it's telling you how often these options are finishing profitably in the money. So we actually update this spreadsheet on our website so that you can kind of see the top volatility scorecard tickers. So those are two huge things that I think that you get when you just go over to our website. Our editorial department's always writing up different stuff about options that we're seeing and having extreme sentiment levels, and that's kind of how we trade. We look at it from a contrarian standpoint from sentiment. We're not trading against the trend necessarily, but we're looking at stocks that are in trend, but people have gotten extremely negative on them. We feel that when you kind of combine those two factors with volatility, that's how you can make those outsized gains. So those are the two things I would say over at schaeffersresearch.com that are huge. But again, you have educational material that will teach you exactly how to kind of trade options, how we trade options, and then we also provide services for them that they can, trade along with us. We send them right out to your phone or email, just like everywhere else. And we want to make sure that you're successful in trading. I mean, that's the goal. We want to profit right alongside of you. So.
Matthew Timpane, everyone. Thank you so much for being with us.
All right. Thank you very much, Neil. Have a great day.
You too. Guys, that's schaeffersresearch.com. Make sure you check them out while you have a chance. Take down that URL. Go ahead and put it into your URL bar. Take a look at Schaeffer's Research.